So 3, 2, 1, welcome everybody to the 71st episode of the Hashtag Invest This podcast. I'm your host, Scott Bauer. Today we have Richard Thornton with us. He's a note buyer. A little bit about Richard. He's actually been in real estate in the industry for over 30 years. Starting in 1985, he co-founded a commercial mortgage company that he then sold later in 2000. And Richard, I'm going to let you kind of take the mic from here. I want to know a little bit more about your background, or our listeners do, and kind of what you're focused on now. Let's talk about it.
Okay, great. Well, thanks very much. So, as you mentioned, I got my start in my mortgage banking company. We had a boutique company. We did large commercial stuff. We sold it in 2000. I then went on to invest in large seniors projects and did that nationwide for about 10 years or so. The REITs came in, though, and kind of took over that market. They had really deep pockets. And I sort of cooled my heels like a lot of people during the recession. And after that said, it looks like flip would be fun. So, I did a small number of those, did 20 or so of those. And as part of that was also a hard money lender, got to know a little bit about mortgage notes and said, hey, I really like this market. Started working on non-performings and performings, and right now I'm focusing on performing notes.
So, that's cool. Obviously it's a very quick 30 years worth of information, right?
Right.
And we'll get to the note side, but first, why? So 2000, the commercial platform that you co-founded. Let's talk about that for a minute. What exactly was that?
Well, so we did, we made large commercial loans, mostly in apartments, mostly through, a lot of people don't know that Fannie and Freddie Mac have the ability to make large apartment complex loans. So our minimum loan size was $100 million. I'm sorry, $10 million. But I did a lot of $100 million packages. So when the real estate investment trusts were starting, they couldn't float their own credit. So they'd want to buy 10 or 20 projects. They would come to us and they'd say, Richard, I've got a $250 million package. Can you finance this for me? So we did that. We sold the company with about an $8 billion portfolio. At that time, the boutique companies had sort of made their run for it. In other words, they were starting to get bought up by a lot of big banks. And that's exactly what happened to us. We were actually bought up by a large hedge fund group and was subsequently sold to a bank. And I think it's part of Wells or some group like that. Now they make the kind of those loans, but they don't even tell you where they got their start. So
right.
So it was just perfect time to sell. Everything like it has its cycle.
Yep, and it was just alignment at the time, and it was a good exit for you to get out of that. And then you went from doing the commercial side into flipping houses. Did I hear you right on that?
Well, I had several stops in between. So I had several large clients, and they pretty much had deep pockets. And so we fished around and bought large assisted living and some nursing home projects nationwide. So let's use Sunrise Senior Living as an example. We okay?
No, yeah, we're good. Sorry, a little technical difficulty on my end on this Facebook Live deal. Anyways, keep going. Sorry to interrupt you.
No worries. We had so we'd buy a large facility. Say it was a $20 million purchase. I'd go out and raise $5 million from investors. We get a $75 or a $15 million loan, and we would own it for 10 years and then sell it. It's typical syndication. So we did a bunch of those. But the REITs came in as they got more and more money, and where I was buying at a 10% yield, they would buy at an 8%, and they could close in 2 weeks because they had a lot of money, and I just couldn't compete with that. So again, it had run its cycle, and it was time to go on to the next thing.
Well, I want to talk about that a little bit more detail on the syndication side of things. Why not do that now? Obviously, syndication is a buzzword out in the industry right now for multifamily investment, commercial investment. There's a lot of people I know that are doing really well syndicating deals right now.
Right. So
what's going to happen with that?
So the reason I'm not in that right now is that I had a larger client base and was doing larger projects. I think most of the guys who are syndicating properties now are doing them on the smaller end. I don't mean fourplexes. There are guys who are doing fourplexes, but let's say 80 to 100 units. And correct me if I'm wrong on that, but that just seems to be to where the market is. I could do that again. I just would have to build up a whole new investor base and things like that. And that's just not where I was pointed at the time. So I've stayed where I am.
Well, there are some people that you and I both know mutually that would say that we're at a certain part of the cycle for the syndication model in apartments. I don't know if that's true or if it's not.
Well, yeah, I mean, I tend to think that it's just about tapped out, that it's maybe 3/4 of the way through its cycle, and that's another reason I'm not jumping back into it. But when I was doing my flips, I was more than busy, and just really didn't have time enough to sort of get back into everything. You have to pick your shiny object that you're going to go after.
Gosh, isn't that a true statement? And I think it's important for the listeners and everybody listening to the podcast. We all suffer from shiny object syndrome. I mean, right. I know when I first was starting out in the real estate career that it was, they're just shiny objects everywhere, really. And it's very easy because you can make money in all of them, right?
Right.
But being targeted, being focused, I think is where you really get ahead. So with that being said, how long have you been buying notes? I guess that's a good segue into the notes section, right? Or is there something else you want to talk about in between that?
No, that's good. I mean, basically during the recession, after I was doing syndications, I sort of cooled my jets and invested in some small properties here and there, and had enough cash. Luckily, had enough cash to live off of, but there wasn't a whole lot that I did during the recession. And then I got into flipping very early, so I was making some really good margins on everything I was doing. But I'm here in California, so in the Bay Area. So there are guys who are still doing it now, but it's a big dollar project. I mean, you got guys who are putting down $600,000, putting $200,000 of their own cash into a deal. So they've maybe got a total of like $400,000 into a deal. And yeah, they can sell it for $1 million. That's great. But if, as you know, it's sort of a game of musical chairs. If the market slows down, that's a real hard slowdown.
Yeah, that's a big bag to be holding open, just waiting, right?
Right. And at one point, the market didn't stop here. I mean, it hasn't really stopped, but this is about 3 years ago. It just sort of caught its breath. For about 90 days, it was like it paused. And I had 6 projects that were midstream. I had a huge overhead and debt service at the time, and I'm going, oh my God, what's going on here?
About to lose it all,
yeah. And luckily, the market picked back up and things were fine, and I went on to do some more deals. But it was just a good lesson to not get too overexposed.
So that's a great point. To point out at this time, don't overexpose yourself. Now, what about somebody that says, well, I don't have any money. I have to kind of overexpose myself in order to move forward, in order to get there to the next level. I have to be overexposed. I have to be over-leveraged to an extent. What do you say to that person?
Well, I guess what I say to them is pick your focus and figure out if you're somewhat recession-proof or not. I think some of the stuff that you and your fellow wholesalers and flippers are starting to do with, for instance, note school, and where you've got some creative finance, where you can actually dig deeper into deals, get more deals, and extend that market is a great example of that. So you got to be creative and be able to pivot, but you got to be careful where you're pivoting to.
Yeah, right. I mean, you mentioned recession resistant. Nothing's recession proof, right? But a little bit of recession resistance. Some would argue that apartments are just that, because you have, the markets fall down, people lose their jobs, they can't afford their house anymore, they're going to move to an apartment. I mean, as an experienced person with 30 years of experience, what have you noticed in that with regards to that? Is that true or no?
Well, yeah, I mean, you are going to notice there was an awful lot of people in the last recession who owned apartments, and their apartment residents weren't paying their bills.
Yeah.
So, it may it has more of a cushion. And I understand that argument. I guess what I'm trying to say is uh, that's mostly true depending on the socioeconomic um, group that you have for residents. If you have a bunch of high flyers that are here in the Bay Area that are all working for Google and they're living in your building, that's one thing. If you're in Akron, Ohio, and Akron, Ohio is a wonderful place, but if you got somebody who's working on the line at GM and you've got a 100-unit building and they decide to close down that line for a while, you're going to take a pretty hard hit whether you're owning an apartment or not.
Right.
So
just know your market, basically, is know your audience, know your market, know who's in your buildings or whatever, or know what you're doing. Be educated about the opportunities that you're dealing with. Is that?
Yeah. I mean, here in the Bay Area during the last recession, it was tough everywhere and for everybody, but it wasn't nearly as bad as other places. I mean, you've got such a diverse economy here.
Yeah.
The engine just keeps going, and even people who who had nice homes and maybe lost up to 30% of the value of their houses, it was only 30%. I know a lot of markets where they lost 70%.
Phoenix.
Yeah, Phoenix, and honestly, so if I looked at my own house, I lost that 30%, but I've made 40% on top of the 30. Getting me back to where I was pre-recession. I've made 40 on top of that since then. Yeah. So know your market, know your audience.
Yeah, and kind of know that this real estate game is a long cycle. You wait long enough, you always get your money back. I mean, that's
right.
So you decided that notes was a way that you could kind of creatively put deals together. Notes was kind of your next thing. How long have you been doing notes for?
So I've been doing notes for about 4 years, and part of it is a lifestyle. So when I had my mortgage company, I had 70 people working for me, and I was being a manager, and I had gone from actually being the deal guy, which is what I really like because I'm a bit of a deal junkie, to being more of the management guy. And that suit did not fit me well at all. So I don't want to go there again. I was sort of, I got gray hair, and I was at not the end of my cycle there, but I just did not want to pick up that baton again and create another company. So in flipping houses, in making hard money loans, and in making notes, I could be perfectly comfortable. I can go, which I have done, I can go live in Paris for 3 months and continue my business, continue my note business. I like that. I want that flexibility now. I like to travel, and I don't want a big overhead. So I've got a crew of virtual assistants and people like that who work with me and for me. And I can, it doesn't take me any more than what you and I are working with right now, which is a laptop computer to do my business. And that's one of the reasons I wanted to get into notes.
That's a beautiful thing. That is such a beautiful thing. It really is. I think it's important for us to define what a note is for the audience, because there are certainly people that are listening to this saying, what are you talking about? A notepad, note of paper?
Right.
You pass the notes in the classroom. What is a note?
Right. So it's interesting. I even tell residential loan officers, because I make presentations in front of a lot of realtor groups, and let's face it, these guys know real estate, and a lot of them are lenders. And I say, well, you can invest in a mortgage note. And I get this blank look, and they say, I can buy a note? And so, they think of a note as something just as part of a mortgage that they get on their house. So when you're buying a note, it's a little bit of a misnomer, because what you're doing is you're buying the dollar amount of the mortgage on the house and the mortgage note. So let's say if it was a $100,000 house and you had an $80,000 mortgage, you can actually buy that mortgage. Banks do it all the time in large bulks. We're doing it on a onesie-twosie basis on smaller deals. Most of the deals that I invest in are in the Midwest, And the reason is that there's more seller carryback financing in the Midwest because the mortgages are smaller. So let's say that you did a seller, you sold a house, your buyer couldn't get financing because maybe he's self-employed, so he can't get a loan for that reason. Maybe he's a Canadian, but he lives here legally. There's any number of reasons why people can't get loans. So you would say, all right, Mr. Buyer, I'll make you an $80,000 loan, and you get $20,000 down, and you carry back $80,000. Fine. A couple of years go by, and maybe you decide you want to invest in some other new shiny object. You have some other opportunity. You want to move to Florida. There's a lot of different reasons. You can sell that note. And there are several exchanges. I do direct mail. There's several different ways you can sell that note. Now, you're going to have to sell it at a discount. If it had at that point, it had maybe $75,000 left in terms of an unpaid balance, you'd have to sell it for less for that, because I'm going to have to get a higher yield on it than maybe the 6% that you made. But nevertheless, you can get some money out of it and go off, and you can do whatever else you do. So that's what I specialize in, what's called seasoned performing notes.
And a seasoned performing note, also for the listeners that might not know what that means, is somebody who has been paying on time over time, and they're not going to default, or the likelihood of them defaulting is much less than somebody otherwise.
Yeah. So if you look at the Mortgage Bankers Association statistics, 80% of all home mortgage defaults happen in the first 2 years. So if you get beyond that 2-year category, then that means only you have a 20% likelihood of default. And that's what everybody wants to know about. Now, what I am investing in is great for somebody who has a retirement income, or they want to save for their kid to go to college or something like that. They can do it through a self-directed IRA, and they can get that yield tax-free, which, let's say if they were getting an 8% yield, on a tax-free basis, that's probably, depending on their tax bracket, about a 10% yield. Well, that's better than the stock market, number one. And number two, it's secured interest, meaning that you have the house as security. So if it was, let's say, a $100,000 house, we probably bought that mortgage for $50,000 or less. So even though you'd have to work with a lawyer and foreclose on the house, you could still sell it and get your $50,000 back. And you can't do that on a stock market type investment.
Absolutely. No, that is a great point. And I think a lot of people out there don't also understand that they can buy these notes, or they can invest with somebody like yourself or myself, right, using an IRA, right? Using an IRA.
Yeah.
And make that 10% yield or better. I mean,
Right. So, yeah, I mean, there are different ways to get different yields. It depends on how active or passive you want to be. Some people say, oh, gee, I want to jump right in and I want to buy a non-performing note. The reason they would want to do that is they get the house on the cheap if it defaults. And I won't get too technical here, but if you're in the Midwest, a lot of houses are financed using a land contract as opposed to a mortgage. The difference being that if you are the owner of a land contract, you, the bank, own the property, and the borrower has a lien on your ownership as opposed to the other way around, which is what we're more used to with a mortgage. So it can make foreclosure a whole lot easier.
Well, yeah, there's no judicial foreclosure. There's no, I mean, it's a totally different beast. And honestly, that would confuse a lot of people if we try to go into that, I think.
Yeah, so that's probably more than I should have gone into already, but.
What issues can you see? What problems out there for people that are buying notes? I mean, what could happen? Obviously, if you're buying a distressed note or a non-performing note, the problem is that it's not performing, and so they're not paying on time. So you're going to have to go in and foreclose. You're going to have to go renegotiate terms. You're going to have to, right?
Yes, that's true. And what a lot of people don't realize, though, is that because of the recession, there's a whole network of people who can help you do that now. So there are a lot of local councils, property managers who can help you rent the property if you decide to rent it afterwards. groups that on a larger regional basis are contractors that can help you go in and renovate the property if you need to do that. I'm not saying it's easy. I'm saying what you are best off doing is to say focus on a market if you want to buy non-conforming notes, and sort of get a network of people to work with that are contractors and people you can trust. And then you can do a number of these, and then it does become a lot easier and you can get a lot higher yields.
And obviously you got to do one first, right? I mean, I think that's myself included. I'm buying notes or in the process of buying notes. It's a matter of buying it, going out there and doing it, going through the cycle, figuring out the way to do it.
Right. So I always try, and a lot of people come to me, and even though I don't have, let's face it, I'm not a sage. I haven't been doing this for 20 years, something like that. But a lot of beginning students or people come to me and I say, look, I'm an open door in terms of helping you out, and I'm glad to. It's one of my give backs. It's one of the things I do. And I often counsel them to just go buy a note, go to Notes Direct, go to one of the different exchanges where you know that they're already going to have done a certain amount of underwriting on the deal. So the chance of you really messing up terribly is a whole lot less. Get as high a return as you would, but you're also not going to screw up as bad. So
right.
It's a good way to, it's sort of a cushioned way into the market and to get used to the mechanics. And then once you do one or two deals through them, you go, oh, this is how it works. That's fine. And then you can go, to Joe Blow and Joe Seller and buy his note and know the traps a little bit better.
Yeah. Just kind of go through the cycle. What else, why is it so confusing for people? Why is it such an unutilized technique? I mean, the majority of the people that I know of had no idea about what a note was, had no idea that they could create their own notes in some sort of seller financing, or just have no idea the power of buying notes over the long term. Because obviously we get into selling partials, we get into different aspects of buying and selling notes. There's this major wealth creation that you can do for it. Why do people not do that more often?
Well, I think you hit the nail on the head. A lot of people just don't know about it. I mean, I have to say that before I started flipping houses, when I started flipping, I bought the houses myself. I was a broker. I just bought the house and saw it. And then somebody said, well, gee, you can talk to a wholesaler. And I looked at him cross-eyed and I said, what the heck is a wholesaler? I had no idea, right? Notes is the same thing. Some people say, well, gee, you could create a note. You go, what does that mean? It's sort of so foreign until you don't know what you don't know. And so until somebody introduces it to you, and I think it's why a lot of people just don't do more of it.
Yeah, that makes a lot of sense.
Plus, they're a little bit uncomfortable with the fact that, gee, what do I do in case of default? And as you say, I think if you're going to do it correctly and do it well, as is the case in your business, there are a lot of little things to learn. And so I don't want to say the barrier to entry knowledge-wise is really high, but I can say that especially on the non-performing side, it can be difficult to know all the pitfalls. I'm not kidding you by saying this. One of my very extensive or experienced partners in this business, comrades, bought a house. I had it fully inspected. It was someplace in the Midwest, I can't remember. They finally, when they say inspected, I mean they had a BPO done on it, broker's purchase opinion on it, and they finally sent somebody out to do a full inspection of it, and they found out that there was no back on the house. It was a two-story house, and it had no backside. It was completely open.
What a surprise.
Yeah, surprise, right? And the pictures were all from the front and the sides, and nobody ever questioned it. And these guys had experience. They had bought like 40 notes already. So,
Well, I mean, that comes with the territory, though, right? I
Yeah,
mean, and unexpected things happen all the time. You can't be afraid of that. But
yeah,
I think that's a great segue into this. In the 4 years that you've been buying notes, what is the biggest problem you've had so far? I mean, have you had a big problem that's like,
yeah. So the biggest problem I had, is I'm working my way out of it right now, is one of my owners died,
oh,
and yeah, and so
happens?
he made his payments, and then he's made his payments intermittently, and you don't really know what's going on with the person. It's not like you can call him up and say, hey, look what's going on. So we did all the proper things. We sent in the proper notices and things like this, and then the payments just stopped. What we didn't know at the time was he'd already passed away, and by the time that he had passed away and we really got on top of it, somebody went in and gutted the building. So there was no furnace, no plumbing, no anything.
So, oh, that's terrible.
Yeah.
So there's the problem. Somebody passed away. Somebody found out that they passed away, raided the house, took everything out of it. What did you do to fix that issue? That could be a potentially very expensive issue just to make it livable again.
Yeah. Well, unfortunately, all this happened just before winter. And as we got into winter, there was 5 feet of snow on the ground, and nobody even wanted to go out and look at it.
Mm-hmm.
So it wasn't until the next spring that we were able to, the servicer and I were to find out that the person died. We had to go chase down their mother, because their mother was the only person that could actually sign off on everything. And so what I eventually did was, I contacted some people through a local meetup that were real estate investors, and they hooked me up with some different contractors. And now I've brought it around, and it's being renovated. And I'm actually going to make money on the deal at the end of the day.
Really?
Yeah, but it's not a lot, but it's something that has taken a lot longer. It's taken me 9 months to work through, and given me more gray hair than I already have. So that's been the
Well,
worst of it, but still, it's not that terrible.
there are certain days that Richard, that I'm so stressed out, right? And you talk about gray hair. They're going to pop out eventually. I know that. They're coming. There's days this week that have been super stressful, and that's just part of the game, right? I mean,
Yeah.
that's with any industry, any business that you're in, you're going to have those issues.
But there are wonderful surprises too. One of the houses that I had, I get pictures taken continually of these houses about once every 6 months or something like that. And I bought a house, and it was okay. I got a really high yield on it. It's one of these houses down south. It has a corrugated steel roof on it, and it looked a little bit rusty, and looked a little bit like a shack. Well, I went in and took the pictures, and I got the pictures back, and holy smokes, the owner has renovated. He put a whole new roof on it. He painted it. I mean, I would buy that house right now and live in that house happily. And so, nice things happen. You can't just say that everything's going to go bad here.
Come with the good, with the bad, right? I mean,
Yeah.
that's a good surprise. I'm trying to think if I've had one of those happen to me anytime recently, and the answer to that's no. But they happen. I know that they do.
Yeah.
Where do you see yourself moving forward from here? Now, do you think you're going to put a lot more emphasis into the note side and, really, really grow that? I mean, you mentioned the lifestyle play, right?
Well, yeah. So I'm fortunate to where through my other activities, I've sort of got my daily nut covered, or at least mostly covered. So my focus is on what's called partials. So if I buy, it's a 30-year note, there's 25 years left on it, I can sell somebody the first, say, 10 years of that note, which is obviously equally arcane and unknown to a lot of different people. They look at you very strange and you say, what do you mean you can buy the first years? Well, it's just like buying an annuity. It's not an annuity, but it's buying an income stream. And so what people like about that is that I don't get any yield for the first 10 years. I mean, I'm totally assigning them the mortgage. I'm helping them out. I'm monitoring it, but I don't get, my pay is 10 years out. So I'm actually building more of a retirement for myself by doing that. I'm sorry, can you hear that? I've got a dog.
Oh yeah, no, that's okay.
Okay. So I'm focusing on partials right now, and that's a great place for me to be.
And I think, yeah, I mean, partials are great. So once again, you can get really confused talking about partials, and we're talking about something confusing to begin with. But if you sell a partial payment or a partial of your loan to somebody, let's say for 10 years, but 5 years from then,
right,
the 10 years you sell them, they decide that they're going to go pay it off. They're going to pay off that entire note.
right.
You still make a very big spread on. I mean, you would get cashed out nicely at that rate, right?
Yeah. So in other words, you've made your yield the entire time. What a lot of people don't realize is that if you invest in the stock market, let's say you invest $50,000 in the stock market, and you put your 50,000 in, you get maybe some of the yield of it, but you get mostly appreciation at the end. So you hope to get, say, 70,000 back, your 50 principal and your 20,000. Well, if you invest in notes or partials, your investment is amortizing. So each principal gets paid down a little bit each month. So your investment is actually safer than just a straight stock market investment. And yes, if Mr. Borrower decides to pay off whatever your unpaid balance at that time is, that's what you're paid, and you're out whole, and you will have had your yield up to that point, and you can do whatever you want to with those funds. You can put them into stocks, you can buy another note, you can do whatever you want. So yes, it's a nice payday.
You got a lot of options is what's beautiful about it. And it's very, I mean, I think you can construct it in different ways, right? I mean, that's the cool part.
You can construct it in different ways. And since you're the bank, a lot of people say, well, they are afraid of the D word, default. And you can say, well, since you are the bank, you could call up that borrower and you can say, Scott, what's wrong? And you go, well, I had a medical problem, but I'm back on my feet now. So you can work with it. You don't have to just say, oh, I'm going to default. You can add $200 to his next payments or extend the loan, or you can be flexible because you are the bank. So that further mitigates the risk associated with one of those investments.
Yeah, that's such an exciting thing. Notes, I mean, since I've started to learn about them, they're powerful. They're powerful.
Yeah, and part of what I like about this business too is that it's, in a way, it's sort of a give back, because a lot of these people wouldn't be getting mortgages otherwise, or wouldn't be able to stay in their mortgages, and you're helping them out. And you're getting a decent yield while you're doing that too. So I think it's very constructive.
Absolutely, yeah. I couldn't agree with you more. You're going after people that don't necessarily fit the traditional mold, people that can't qualify for loans, right? But giving them an opportunity to still live in a house.
Right. I mean, they're making a perfectly good income. I mean, they're school teachers, they're iron workers, they're farmers, they're whatever they do. But because they aren't W-2, or maybe they don't have clear American citizenship or whatever, they can't get a loan.
We get penalized as entrepreneurs because we take the risk. So we're risky people out there, right?
Yeah. So, I mean, I have to say to myself, if I tried to go out and get a home mortgage right now, different lenders would look at me and say, I don't think so. Just because, my income comes from a lot of different places and they don't necessarily like that.
Yeah, I can attest to that as well. Anyways, so Richard, are you ready for a lightning round?
Sure, go ahead.
All right, let's start off the lightning round. If you could give our listeners one tip to keep them moving forward, what would that tip be?
I would say be really flexible and able to pivot quickly, especially in this market. Read a book called Elon Musk by Ashley Vance. Talk about, whatever you think of Elon Musk, he's eccentric, that guy can pivot, and you will get some real lessons about how to pivot in a market. And I think put your pivot pants on and be ready to be flexible. That's what I'd say.
I want to say, and that actually leads right into our next question, but I think there's a book called Shift, and I want to say Gary Keller wrote it.
Yeah.
But anyways, it's similar to that pivot mark. You know, you got to be able to pivot. You can't be stuck in one way. You have to be able to move and be fluid so that you can capitalize on what's going on in the economy at each time. So anyway.
Right.
Well, the next question of our lightning round here is: have you ever, or what is your favorite book that you've had that's had a massive impact in your life? I think you just said it.
Well, that's one, but actually I'd have to combine two books to answer that question.
Right.
Start with Why from Simon Sinek, and then Build a Brand Like Trader Joe's from Mark Gardner. Both of those talk about starting your company from your why. In other words, your why can't be just to make business or to make money. Your why has to be something like Steve Jobs had for Apple. You know, he really wanted to make a difference in the world. And when you're dealing with that, coming from that place, it makes it much easier for you to pivot or do anything else in the world.
Yeah, no, I think that's important in anything you're doing is why are you doing it, right?
Right.
It's very easy in this real estate investing space or just real estate in general to just chase after the dollar.
Right.
I can also attest that when you chase the dollar, it runs from you. So don't do that.
Right. It'll come to you if you have a good why.
And focus on the process, right? Have a good why, focus on the process, and you'll eventually get paid for it.
Right.
Who has given you some really good advice? What has that advice been? What can you share to our listeners?
I'd say it's actually one of my previous business partners, and his advice was treat your clients like your friends. So it's not that you have to put your arm around everybody, but do deals with them as if they were your friends. So in other words, don't throw them bad meat. Make sure you've got a good product. Treat them the way you would want to be treated by yourself, and that'll get you a long ways.
Was that golden rule? Is that what I was, golden rule? Treat other people as you'd like to be treated, right?
Yeah, do unto others. Yeah, sort of like that. Yeah.
And I think it's just universal in people in general, right?
Right.
You'll always get a better response that way.
Right.
How do you, I know that, how do you like to give back? I'll just ask the question. How do you like to give back?
So my give back is something I've done lifelong. I always participate. So when my kids were young, I just didn't take them to soccer and drop them off or sit on the sidelines. I got in the mix. I became the coach. I sat on the soccer board. I was always part of the mix. I'm doing that now through my note stuff. I'm being open in terms of giving them an opportunity or giving people an opportunity to learn from me. I give people documents. I do all sorts of stuff. So I try to do it as a constant give back.
And, I think not only is that a give back, but it's also a way for you to be present, right?
Yeah, exactly.
So many of us, and I think everybody can be included in this, there's times when you're not present. Your mind's in another space where your physical body is, or you're thinking about stuff when you're talking to your spouse or your kids or whatever, and you're not present. The fact that you're able to go out there and participate and make yourself present in all these situations probably helped out the relationships you had, helped out your understanding of everything. That's huge. So my hat's off to you for that.
Yeah.
How can the listeners reach you? They want to know more about notes, or how can they invest with you, anything like that? Where can they find you?
Okay. Well, my phone number is 510-918-9001. You can always call me. I've got a YouTube channel, American Note Capital, and I've probably got a dozen videos up there now, a whole series on investing in notes, what it entails, and just how a lot of seller carryback notes are financed. You can find me on LinkedIn, just under Richard Thornton, and you can find me on Facebook at American Note Capital. My dog really wants out.
Maybe the dog wants to be on the show. Maybe he knows he left out.
Right.
Well, we're going to make sure to include that in the show notes. And actually, I'm going to hop over to Facebook and see if we have any live comments, because one of the big things that I'm doing the Facebook Live is I want everybody that's watching this to like it, to share it, and I want to see your comments, because this is a kind of an interactive thing. we talked about notes today. Most people have no idea what that is. So ask us some questions. Let's see what we can put out there.
Right. I'm gonna be right back.
Hang on 1 second here. Ask us some questions. Let's see what we can.
I'm back.
Raise. Oh, you're okay.
Yeah.
All right. So, we don't have any questions out there today. I'm sure they're going to trickle in. This is still a new process. We're trying to get people to, see what's going on. But
yeah. Well, so if people do come up with questions after they've watched this, I would really urge them. My YouTube channel is a great way to learn more about it. A lot of the videos that I made, the series, they're anywhere from 5 to 15 minutes. So you can clip them off and do it at your leisure. It's really simple. It's not like it's this big, long, boring thing that you have to watch. And it's just a great way to learn more about it. So that's one thing I would urge them to do. And then also, I've got a Facebook group, Maximizing Wealth, but you can get there through my American Note Capital Facebook. So like that, join the group, and I'll be glad to add you to any of my lists so you can learn more.
Man, I love that. I think you added a ton of value today, Richard. Thank you for being here.
Well, thanks for the opportunity.
Super exciting. And I know that we're going to stay connected. We just met actually, what was that, 3 weeks ago, 2 weeks ago, something like that?
Yeah, right. At a note event, so.
Yep. And so excited to, stay in touch with you. Maybe someday we'll be able to do some business together. I guess.
I'd love to do that. I'd love that.
Sounds good. Well, we will talk to you real soon. Thanks again. We'll see you later.
All right. Bye-bye.